What we found is that if you're a small central bank trying to manage your currency, or even with an explicit currency peg, then negative rates can certainly be a very useful tool for you to do that. Our ARIA survey gave a 90% approval rating to the Danish central bank for its negative strategy. If you're a large central bank managing a big economy and a reserve currency, then not so much. We got negative ratings for the ECB and for the Bank of Japan.
And they were also asked about how much lower this lower bound rate path could go and for how much longer. What came through there?
Right, so we're stretching into 2018 in negative rates for the major economies, and we're going down as far as -1 for the Swiss central bank. It probably has to plumb the lower steps because it's surrounded by the euro area, the kind of dead weight of the euro area that's going to be continuing to ease.
Jeff, makes for sort of fairly fascinating reading. That's, of course, one of the main stories, most read stories on the Bloomberg today. Jeff Black, thank you very much in Frankfurt. Now, Sakun Sebi from Hermes Investment Management is still with us. I mean, I found that fascinating. 63 economists. I mean, they are slamming the view that this is going to
work.
Yeah, well, it's going to get to 2% inflation. It's not going to grow. It's not going to get.
Well, it's not. So, I mean, it just tells you that the central banks have reached the end of what they can do. You can bring interest rates down to zero. It's questionable, actually, by some economists whether interest rates follow or lead economies. But let's assume they lead economies. Let's just give them that. You come to zero, and then what do you do? And it clearly does not work, and it shows that, to my mind, it shows desperation than inaction.
Desperation, value destruction? Are they weapons of
value
mass
destruction?
Value destruction?
Not yet. They need to go. I mean, what is it they're trying to do? They're trying to convince people to spend the money in the economy rather than put them in the banks. I mean, that's the whole point of negative interest rates. 0.5% is not enough. If they really, really want to force people to spend money, which is what they're trying to do, to get inflation back up again, you've got to go to much bigger negative rates, which is an experiment that nobody's done ever.
You see, I actually fundamentally disagree with you. I think society is so scarred from 2007, 2008. I challenge the fact that that would even work.
I don't think it would work. I mean, I think you're exactly right. This is still 2008 working its way through. We haven't come out of the crisis. We solved the short-term end of the crisis. We haven't come out of the crisis to go through. And we have a lower growth economy structure. We have to get used to it. Coming in, listening to the radio before I came to you, all the talk is about the OECD predictions as if it's a bad thing. Look, 3% is still good growth. 2% in the US is still good growth. We just heard now Mr. Sommer saying that inflation is not going to go up. Get used to it. Deflation is more normal in human history than not. And central banks have got to realize they cannot control economies as much as they think. That's it. It's going to be tough. Sorry.
Okay, I mean, that's the news. What I've got here is transparency. So we've talked a little bit about the negative rates, and you're calling it much lower. These are some of the 10-year government auctions, which are all sub-zero. I'm talking about Germany, Switzerland, Denmark 3-year paper, German 5-year auctions, all as recently as the start of this month, all sub-zero. Look, this is what fraught the banks, okay? The sub-zero, the negative rate, and the contingent convertibles. Would you have any banks on the books?
We have some banks that we have we have bought, but we're very careful. We're very nervous about what this means.
In terms of the negative bond rate story, do you agree or do you buy into the theory of recession if you use yield curves? There is this great debate here at Bloomberg. We've been looking at the yield curves of the United States. We've been saying essentially they are inverted. Do those models still work, or do we have to throw those out and be happy with 2–2.5% growth and believe that that is a new normal?
I think we have to throw the models out. The models assume a relationship between bond yields and equity yields. That's where you get that from. And it assumes a relationship between the risks on the two elements. And what's clear is when you bring interest rates down to zero, the model just stops working. So you might have a recession, you might not, but the model does not tell you whether you are. All that we can tell is that the US economy has had a reasonably good run for 4 or 5 years, and cyclically it must be coming to a slowdown period. I mean, it just has to be. We know that the Chinese economy is slowing down normally, so that's okay. And the European economy is sort of tottering at the brink.
Saka, when you sat down with me just under an hour ago, you said, Manus, run me through the Allianz numbers. And I said, yes, they've missed on the dividend, Saka, they've missed on their net income. There's no sign of a share buyback. And you paused for breath over it.
I was surprised. If you looked at the consensus in the market, again, I was doing this as my homework because you're a tough interviewer coming through.
I'm a pussycat.
Go on. The consensus actually was the market had upgraded. So they had assumed that, yes, they had a tough time in the asset management business, but in fact, their mainstream insurance business had done well, and therefore earnings would beat and dividend would be maintained. The fact that they've not beaten, and in fact dividend is being cut, you tell me, is worrying, and maybe they have a bigger problem in the asset management than we thought.
I'm about to speak to the CFO.
Let's ask him.
What would you be your first question? What would your first question be? And I will use it.
So why is there such a mess? And is it to do with your asset management business?